Welcome to More Than Legal, the show where we go behind the scenes to uncover the fine print of power, purpose, and profit. I'm your host, attorney Danielle Laughlin. After almost 2 decades in the trenches of courtrooms and boardrooms, I have learned that every move leaves a mark and every deal tells a story. What will we uncover today? Let's find out. Hey, real quick, before we dive into the episode, remember, nothing you hear on this podcast is intended to be legal, financial, or tax advice. I invite you to contact any of the guests you hear by looking in the show notes for their contact information, or if you'd like to reach out to me, you can find my contact information at daniellelaughlin.com. All right, now let's get into it. All right, we are so pumped to get started today. I am very, very happy to introduce you to someone who's grown to actually be a friend. And I want to thank you, Jill, for coming today. I've been looking forward to this conversation. Jill is an industry pro in commercial lending, and I'm going to let you introduce yourself for the audience and just give them a little taste of who you are and what you do, and maybe just why they want to listen to you.
Very good. If I can start, I was told that I need to read a disclaimer. So I'm just going to say the views and opinions expressed in this podcast are solely my own. They don't necessarily reflect that of anyone else, including United Community Bank, where I'm currently employed, or any other employer in my past. So there's my disclaimer. So
we love it.
So about me, I've got a long career in commercial lending, almost 40 years, all in the Atlanta market. I started out straight from college, a degree in finance, and it led me to Trust Company's training program, Trust Company, then SunTrust, now Truist. What I got back then is there were commercial lending training programs back then. They don't exist anymore, at least not commonly. They were very common. We'd have classes of 30 to 40 and the program was like a year or two. But the big thing about it was we had Georgia State University professors, and it was like getting a master's program in commercial lending. I still use probably 90% of what I learned in those first, I was on the training program for about a year and a half. And that's really a firm foundation. And that's really a firm foundation that doesn't, and you sink or swim. And the thing about commercial lending is we have goals. Like if we don't say yes to your loan and get it over the finish line, we don't get paid. So know that while we have to protect the bank, we're on the borrower's side in terms of trying to get the proper information, get them to give us what we need, get them to give us what will support what we're trying to do. I've been at a couple of different banks, made my way around. 6 years ago, when Wells Fargo decided to shut down its business banking group nationwide, there was a team over there that by the end of that day that they made the announcement said, Jill, wherever you go, we want to come to. And so had a team in place. We came over a little less than 6 years ago. And so I've been in this market, like I said, almost 40 years. So I have one thing I know. I'm a one-trick pony. I've been in the weeds. I've fought the big fights. And at the end of the day, I've always been with banks that want a relationship type banking structure. We consider ourselves walking along with the customer through their organization to try and get them what they need from the bank. No more, no less.
I love it. I love it. Well, I went to Georgia State Double Panther here. So I will say their educational program is amazing.
My husband
I did not. Panther. Yes, go Panthers. I've got 2 going to Georgia State this coming fall also. So big shout out to Georgia State. I did not know that about the commercial lending training. And it makes so much sense. That literally just gave me about 17 aha moments with some of the experiences that I've had as an attorney closing transactions with banks and things like that, where I was wondering, is it me? Am I missing something? And now I'm kind of understanding maybe the lender may not, or that particular banker may not have the education and training that.
And it varies within banks too.
Yeah.
So it's really, a lot of it has to do with who you are working with at the bank.
Yeah.
The bank
Well,
matters too, but the banker really matters.
yes, yes. And I also appreciate that you really laid it out there in terms of the incentives, because a lot of times business owners, even those that are starting up, they're trying to figure out how to fund. They oftentimes don't have the things they need in place, which we'll get into more, but they're just, they don't know what they don't know. And a lot of times they feel like the lender, i.e. whatever banker they're working with, is in it for the bank.
Yeah, sort of an adversarial.
Them
against
feels
us. Yeah.
them against us. It feels super personal. Questions about very valid things become almost agitations. And so it's important for everybody listening. If you have gone through commercial lending, if you want to, if you've thought about it, if you've tried it, please just hear what Jill is trying to tell you today. Your bankers want you to get the loan, provided that you can meet the requirements that are not just bank requirements, but are also regulatory.
Yeah. I mean, the OCC looks, and lots of other agencies look over our shoulders. We can't just, as one boss would say, willy-nilly do whatever we want to do. We have to treat customers fairly. And I can't do for one customer and then do something else for another like customer. That would be wrong.
Absolutely. And I think we're grateful for that. We don't want our bankers picking and choosing who it is that they get to help and not help. So right. I think it's great. So I want to talk to you today. I mean, man, we're always in an economy, right? But right. Where we're sitting in any economy at any given time can have a lot of impact on what's being talked about in the news, what people are worried about. And the climate right now, at the time that we're recording this, at least here at, right after the end of Q1 in 2025, is pretty wild. I'm going to say wild. And there's a lot going on out there, a lot of fear and a lot of uncertainty. So I want to get right in with you because, I know one thing about you, and it's one thing I really love about you. You just tell people like it is. And so I know this conversation is going to be so great for our listeners today. So can you tell us, how is the current commercial lending environment shaping trends? And how do those trends impact the mid-sized companies out there?
So let's start with defining what commercial lending is. So I'm a bank, so I'm not going to be talking about non-bank lenders or outside of that scope. And sort of mid-sized lending, we consider that companies between around 10 million in annual revenues up to about 250, give or take. And then with financing needs up to about $50 million. So that's sort of the 9 dots that we're talking about here. And yes, there's a whole lot of craziness going on out there. It's always something. It's never nothing. They're always concerned about something. Right now, it does seem to be heightened. We've got a new president that is changing things around. So who we deal with as bankers, we're dealing with the owners of the business, the entrepreneurs, the people who are responsible for making that business successful. That's a whole different mindset. A lot of times you've got risk takers, and they know what it takes to survive. You don't own a business and not have a time when things have been down. It goes like that. There's good times and bad times. And times like these are opportunities. So if you've got the right business owner and the top 20% of the market, they're going to be going, oh, this is my time. I can really leverage this. I can get rid of some competitors. Right now, we've got these tariff things going on. By the time June gets here, if and when this airs around then, I think a lot of that will be patted down. I don't think it'll all be patted down, but I think a lot of it is going to be taken care of. And for a business owner, really what you need to know is, what's your worst case scenario? What's your best case scenario? And what if nothing changes? So you want to work inside that scope, and you got to know your numbers. I was talking to one customer. We've been calling all our customers about the tariff. Any lending customer we're calling, having a conversation. What do you think tariffs are going to do to you? And most of them already kind of have, well, yeah, they're here. We have fixed price contracts, but now we've got clauses in there. Or, we've been through this a couple of years ago because tariffs aren't a new thing for many customers. And we have these clauses in there that we can adjust pricing. And so you talk it through with them to see where they're going to be and make sure, they're looking at all the right things and taking into account what they need to be looking at.
I love that. You're an advisor, right? You're taking the noise from outside. You're calling your customers, which I think is amazing. Some of you may have some relationships out there you want to rethink after this conversation. But you're actually calling and saying, how are you feeling? What is going on? What are you afraid of? And then you're giving them peace of mind because you're reminding them, and maybe they're even reminding themselves in the conversation, that what goes up will come down, what goes down will go up. This is the cycle we all signed up for. And I think it's so critical because the entrepreneurial maturity requires a resiliency and an ability to see, okay, maybe right now it's tough. Maybe I need to get my contracts updated. Maybe I need to talk to my own customers and see if I can start a conversation on collecting some AR that maybe they owe me or something like that.
They might need to talk to their lawyers too.
They might need to talk to their lawyers. So I really love that you're taking that proactive approach. And I do believe, I appreciate that you clarified commercial lending as well, because it is a different mindset. Because a consumer banker is not calling anybody. I mean, I don't want to disparage anybody, but I don't think they care so much about whether their customer is successful financially. They just want them to pay the bill. But with commercial banking, the more successful that client is.
We're a trusted advisor.
You're a trusted advisor.
Lawyer, banker. If a business doesn't have a good team around them and doesn't have a really good relationship with at least those three, if not more, they're probably not running their business very well.
Yeah, we definitely agree with that. I mean, and sometimes it's just a matter of you got to learn the tough lessons sometimes before you realize, that's important.
There's one more thing. It's proactive with the information too. Please don't let me be the last one to find out that you're doing stuff. There might have been something that we could have put in place. I know just recently, one of my customers, they're getting ready to buy a building, and he was going to buy a house for his mom. At first, I thought, oh no, that might throw off the debt service coverage. Went and talked to the underwriter because he's going to be renting it out. We know the situation well ahead of time. It was a total non-issue. But if that had come up and I didn't know about it, or my underwriter picked up on it and said, hey, what about this, Jill? I'm like, I don't know. I never heard anything about that. It's a whole different scenario. Something that simple can throw something off.
Oh my gosh. That is such an important thing to understand too, because they're doing paperwork to get the loan. They lock in, and then there's a closing that happens at a future date. And anything that you do with your credit, and it is your credit, folks. I do want to also say that until you get to, maybe some of the mid-sized companies, maybe not quite as much. But if you're a smaller company, it starts with your credit before you ever have this business credit that you build up. And so there's also this idea that your personal credit worthiness is direct correlation to whether your commercial lender can fund you.
Yeah, because most of the time, if you own your business, how are we going to get your attention, Mr. Business, unless we have you personally?
Mm-hmm.
The bank doesn't want your assets. The bank wants your attention. The bank wants to be able to reach out to you and have you respond when we need you to. That's what a personal guarantee is for. Granted, I guess it is so that we can take assets. But in my almost 40 years of doing this, never, not once have I seen us take assets from a personal guarantee. So
Yeah, I love that.
thousands of loans over the years and never once. And also, this is kind of a personal hot button of mine. We will pull credit, right? So we're going to get a FICO score. And if you have something down in the high fives, low sixes, I'm going to wonder about the business and how it pays its bills. If you've got something in the mid to high sevens, low eights, it's amazing how you'd say, but wait, that's personal and this is business. But you own the business.
Correct.
And how you pay, your philosophy on how you pay bills is seen in your business. And
your philosophy.
Mm-hmm.
Your ethics.
It's not a huge thing if there's a story or something happened. And there have been, over the course of my career, 5 or 10 good stories. That's about it. The rest of them are just stories. Get a hold of your financial FICO score and make it
Get
good.
your free credit reports, folks.
Yep.
Yeah, it's a great
Very
point.
important.
I love that so much. And I love that you said it's about philosophy, because I'm big about ethics. This is about the ethics of how you run your company, who gets paid first. And we've been on the other side. I was a bank lawyer, as I told you. I was a bank lawyer before I started this firm. And even in this practice with clients that are on the other side of that relationship, I have to tell clients, that's not your money.
Mm-hmm.
That money belongs to all these other people, your employees, your lenders, your investors. Until you turn a profit, you cannot ethically remove money from your business. And legally, it's also not appropriate either. Whether that ever catches up with them or not is a different story. But I really try to impress upon folks, like, this is about the mindset. And
you're touching on something that's really important. So a mature business that does well, in banking, we always say, do they treat their business like a cookie jar? Is it their cookie jar? Do they just reach in? Do they run all their personal expenses through, all of that kind of stuff? It's fine to run appropriate things through your business. In fact, that's a reason to have your business.
Right. It's a benefit.
Try and run everything through or inappropriate things through, especially if you're a borrower. Why does that matter, especially if you're a borrower? Because you have some kind of debt service coverage that the bank's going to review from time to time. And if you aren't able to, normally it's around 1.25 to 1. And if you can't make that ratio, if you have drained the company, if you have withdrawals or dividends taken out more than you should, or run so many expenses through that, hey, I'm really making money, I'm just not wanting to pay Uncle Sam. Well, you should have thought of that when you were taking everything out. The numbers are, I can't approve your loan because on paper, the paper you have given me shows that you can't afford it. I mean, sometimes you know they can, but on paper, they can't. So you can't approve the loan. We would like to. Remember, we only get paid if we approve the loan and get the loan done. So we're sitting there looking at them like, really?
Help me help you.
Help me help you. So that's a big one. And then there's the 5 C's of lending, underwriting. One of the C's is character. And we always say, back to our training program days, character is the most important. Because if somebody wants to cheat you, They can. What's the most risky loan? The riskiest loan is a cash secured loan. Why? Because if you have to have cash to secure it, it means it's risky. If you don't cross a T or dot an I and something's wrong with and they're going to take advantage of you. So it's really important that you're dealing with credible people. There's another little story. I've got a little tip, and some companies think that it's like a bad thing. And I'm jumping ahead to one of the questions later, which is the workout piece of things.
You take it. This is a conversation. We got questions to make sure we stay on track, but I never stay on track. So
yeah, I don't think the two of us have ever stayed on track in any of our conversations. So when a company goes through workout, after the fact, let's just say a new customer, I'm talking to them, or their existing customer, and I know they've been through the workout area of the bank, but come out on the other side. They rehab, they got things in order, whatever was causing that concern or their ability to not be able to repay the loan was fixed. My opinion of that customer, that company goes up. Why? Because they've made it. So they've learned through that experience. Probably part of the learning has been in their reporting and the quality of their financials and knowing what that top line number is, knowing what their expenses are, knowing what's coming out, not taking too much out, not having a lifestyle that lives so large that you've got to, keep diving into the cookie jar to get more money, more than you should. A company going through workout, a couple other points about if you're a banker, let's just say you can't pay. So number one, we talked about it already. The sooner the better you can be talking to your banker about, I've got a problem with something, the top line, the sooner the better. Let's hear about it, because sooner the better, it's going to work out better.
But because then you won't have to call somebody like me.
Right.
Because the bank is coming after you. And then ultimately the bank is the bank.
But still, let's slow down for a minute. If you're talking to the bank, we're not coming after you.
That's true. Exactly. That's exactly what I'm saying.
We're not coming after you unless you're not talking to the bank.
Exactly. That's exactly the point.
We want to think about it. Put yourself in the bank's place. We just want you to repay our loan. Do we need to do interest only? What do we need to do to try and work with you so that the ultimate outcome will be you are able to, at some point in time, repay your loan? So and I want to put this in borrowers' minds too. If you know you're going to the workout area, that's not bad. Why? Because we're considered line bankers. So your normal banker that comes to see you, that does your banking all day, every day, we're the line bankers. Workout is behind the line. If you're moved off the line, there are things workout bankers can do for you, such as interest only or adjusting your payments, skipping a few months, whatever it is that line banker, we can't do. Remember, it goes back to what we started the conversation. I have to treat customers the same. Well, I can't take one customer and say, yeah, it's okay, don't bother paying us back. Sure, take a few months. But they can. And so therein lies the big difference. So, I always think it's a good thing, and I try and explain it. If somebody's having trouble, let's get you to the workout area so that we can, before the company is really in jeopardy.
Absolutely. And I was working with the behind the line bankers because I was doing creditors' rights and bankruptcy.
Mm-hmm.
And all we ever were trying to do was create a modification so that we could keep the loan active.
Right.
Now, the last thing we wanted to do was take another house. This was mortgage bankers, so it was a little different.
Any kind of asset is going to be costly. And a forced sale of any asset is not going to utilize the highest
and best use
price for that asset.
Absolutely, because
Mhm.
the bank has rules around what the bank can do. So
Yep.
if there's any equity left in your home or your commercial property or whatever,
You got
guess
to
who
come get
gets
it.
the benefit of that? Whoever buys it from the bank.
Yeah.
The
Yeah. It's a
bank
win-win.
doesn't actually get it. And so I love this conversation because now a lot of the listeners here that have larger, mid-size, like you said at the beginning, we're talking 10 million up to 250. I mean, this is a huge kind of spread. Most of the clients that we work with are kind of 10 to 25. And
Mhm.
so, and a lot of them are in construction, media, software stuff. So a lot of the times I see this fear-based mindset around bankers, lawyers, and accountants.
Mhm.
And I try to harp on them. We are not here to tell you no. We are here to find a way to say yes. But
Mhm.
if you are so afraid that we're going to say no, that you never talk to us about it, how can we help you? We
Yeah.
can't.
Yeah.
And so
Communication is everything.
it's everything. And I'm just so grateful that you're willing to just say that to folks because when they're in the thick of things, mindset, like we talked about, it will make you think and see and believe things that are untrue.
Mhm.
And especially if you've gotten into a financial situation. A
Right.
financial situation risks everything,
Mhm.
right? Like, so the entrepreneur goes, "Oh my God, my business is at risk. If my business fails, my spouse is going to leave me. I'm losing my house. My best people are leaving. My kids are going to think I'm a failure." And then all of a sudden, they spiral. And so I believe, just like you said earlier, that by the time we get to June, we're going to see a lot of this shaky stuff be better than. I'm not a fan of tariffs. I want to put that on the record for everyone out here. But just like you said earlier, tariffs are not a new thing.
Well, and I
And
don't think the long-term goal is to have the
it's
tariffs in
not.
place. The
It's
whole
not.
goal is to get people to remove them and have a 0, 0 or very low. That's the whole goal.
Exactly. That's the whole
We
purpose of
just
it.
haven't seen it play out, so there's all
We
this
haven't.
uncertainty, and that's what the markets are reacting.
Exactly.
Mhm.
I agree with you. I think that's right. I think that's what everyone out there who understands this stuff is saying. And hopefully, for the listeners here, if you're not listening to people saying that, you can maybe find some alternative places where you can listen to folks that will be saying things like that because none of us know the truth of that. But what's important about it is not to get caught up in the
In the
hype.
hype. Mhm.
And if you're getting caught up in the hype, you're going to make a misstep. And if you make a misstep, people like Jill are not going to be able to help you if you turn this molehill into a mountain and start making poor decisions and not calling your banker and not trying to figure out what you can do. So please go ahead and just take this as a PSA to talk to people like Jill who really do know what's going on and can help you make some good choices. So I want to get into a couple of these other questions though, because they're good, they're juicy,
Mhm.
and they're really about helping. So we talked about what it looks like when we're not doing the right things and how we can kind of get off track. What can we do? What are the biggest challenges that they have, and how can they consider the next steps and certain things that they can do to start changing the way they view money, the way they view banking, and maybe even the way they view their business, like you said, like the cookie jar effect. What do you think are practical steps for them to take?
Well, so we're talking about lending here, not just banking. So we're going to kind of focus on companies that need to borrow money. So one of the first things that I think almost every company should have is a line of credit, even if you don't use it. And the main thing there is you put your line of credit in place when you don't need it, not when you need it. The answer is going to be very different if you wait until you need a line to get a line. Lines should be in place for all companies, whether you need them or not. So a line of credit, by its very definition, is sort of a short term. It's the working capital. It's the current asset and current liability part of your balance sheet. Anything under a year, it's for short term. And a point I want to make about lines of credit is you will hear one of the covenants will probably be you clean up your line of credit. It means you zero it out, normally for a period of around 30 days, once a year. Why is that important? Why does the bank even ask for that? What it does is it proves that it's short term. Because if you can clean it up by that very definition, it means it's not a long term. You are just using it to fill in gaps. Perfect example is somebody that imports from overseas. They have to pay when it leaves the factory. But then when it leaves the factory, it has to get to the water. Then it has to get on a boat. Then it has to come across the water. Then it has to get off a boat. Then it has to get on a truck. And so you can have 30 to 60 days and not even have what you've paid for. So that is a gap, but it's a short-term gap as soon as you sell it. And so that's what lines are for. There's so many customers that want to not do that cleanup, but they can. They dividend everything out of the company or run it so lean that they're never building up the equity. You can't grow, or it's a whole lot harder to grow when you do that to your company. Keep a proper amount of equity in so that your company can grow. And if you keep your line cleaned up, you're going to save a ton of interest. I mean, I shouldn't even tell them this because the bank wants your interest, right?
Right.
But we really don't. We want you to we want you to use your line appropriately. And if you keep it cleaned up occasionally, you're going to get better terms. It's going to work out better for you, the customer, if you do that. So then you've got other things like term loans and mortgage loans. Mortgage loans, just a really long-term loan. And its collateral is real estate. Shorter term loans are for like equipment. And the term of the term loan will kind of mirror what the useful life of the piece of equipment, like a car or a forklift or something like that, 5 to 7 years. And you're going to pay principal and interest. And then for mortgages, it's 20, 25 years. And then there's fixed and floating rates too. So customers sometimes get a little confused about that. We just retired the LIBOR rate. So now I think we've kind of gone with SOFI, although nobody likes that as much as we used to like the LIBOR. And prime just seems a little clunky. But those are your floating rate options. And that floating, like prime is 7.5. If you're a prime plus a half, you're at 8%. But if prime goes down, your interest rate goes down. If prime goes up, your interest rate goes up. Versus locking into a fixed rate of interest for a period of time. And then you don't have to worry about that. Mm-hmm. Of course, if you know rates are going down and you feel really strongly that way, you may want the floating rate.
The floating rate. Yes, absolutely. And I love that there's a lot of different levers that can be tugged on, and collateralizing property and, like you said, using a line of credit for the short-term gaps and not to buy equipment, right?
Don't put your equipment purchases on your line unless it's like a 2 or 3 week and you just have to turn something around to do so.
Exactly.
But yeah, that's not where you should go to finance your vehicle.
Yes.
Or any other long-term asset, long-term part of the balance sheet, long-term debt, not short-term debt.
I mean, this is a lot. I'm over here taking notes. I'm like, I can't wait for this transcript. I gotta, get my own. I gotta go look at my own debts and assets and figure out, am I using my credit the right way? Because I think, even when you're an entrepreneur and you cross that threshold into understanding your numbers better, really understanding the percentages you're aiming for, the next step usually is that you begin to manage debt, aka leverage, right?
There's
And
good leverage and bad leverage.
good leverage and bad leverage. And so you also mentioned at the beginning that we're not talking about other types of loans that are out there. And so there's other ways to get money. Maybe
money
not
lending,
hard money
larger
lending,
interest rates and stricter terms.
stricter
You will
terms.
your assets very promptly.
They
You
sure
don't.
will. They sure will. And it's interesting because you get to hard money lending when your traditional lending cannot be approved. And so I really hope that everyone listening to this thinks about this very clearly. There is hard money lending out there, and sometimes it's actually beneficial depending on the situation that you're in.
Banking money is always going to be should always be your cheapest source of money.
And don't we want cheaper money?
If you go get equity somewhere, you're giving away your business.
I
always wonder when I see some of the decisions made where people give up equity.
And people give up equity because they're afraid of debt.
Mm-hmm.
I don't want to have debt, so I'm going to give up my equity. That is a strategy that you really want to think a lot about.
Yeah, let's talk about that one. Yeah.
Let's talk about it. We don't have enough time for that one. I'm going to bring you back for that one.
That's a whole, again, philosophy about how to run your business.
It really is. Mm-hmm. And there's a lot of great commentators out there as well that talk a lot about this stuff and really help people understand. What we'll do for the audience too is we're going to give them some contact info for you. We're going to give you guys also some resources of other places where you can find information that will really help you understand banking, lending, equity, leverage in a totally different way so that you can kind of take those blinders off, because a lot of times we're in echo chambers.
Mm-hmm.
Bankers are in banking echo chambers, lawyers are in lawyer echo chambers, entrepreneurs are in entrepreneur echo chambers. And I, being a lawyer and an entrepreneur, get to be in both of those echo chambers, which is a very interesting experience in life, I have to say. But in the entrepreneurial group, a lot of everything you said today is what people take for fact, that the bank is against them, that, oh, that's okay, there's hard money options out there, that all I really need is a partner. These are myths of entrepreneurship that people constantly believe is fact, and they do not discern the truth of it. And so I'm so grateful for this conversation. We're going to close out with this because we're coming up on our time here anyway. What is one piece of advice that, and it might be more than one because you're you and you have a lot of good juicy stuff to share with us, but what's one or two or three pieces of advice that you would give to business owners who are looking to secure financing in the next year to ensure that they are able to make the best financial decision for their growth?
First thing is start talking to your banker as soon as you have a pretty good idea what you're going to do, or you may not even know what you're going to, how you're going to do it, but you know that you're going to do something. You know that you're going to buy a piece of property. You know that you're going to upgrade your fleet.
Hire people.
Hire people. That goes back under the line, hopefully.
Mm-hmm. Working.
Yeah. Hopefully there's a short period of time that we can get them
profitable
for your business so that they're not a long-term debt creator for you. And then to the third partner, your CPA or your accounting firm, is the quality of your financial statements. This is the one that I think is the biggest point of confusion. And I know it's expensive if you to go from just internally created numbers to compilations to reviews to audits. I get that audits are like ridiculously expensive, but even reviews aren't that much. And so banks take comfort in the quality of your financial statements. And guess what? You should take comfort in the quality of your financial statements. If you have somebody looking over your shoulder doing it right, you're not going to get into trouble either. So it's really a win-win. The customer should want it. And so often I hear, well, so-and-so has been doing this for us since she was 20 years old. No, she has no formal training, but she can do our books just fine. Whenever I hear that, I mean, my eyes just glaze over because, they love this person. They've been an integral part of the business. The owner feels like they have helped them grow and they don't want to do a disservice to that person. So
and they trust them also. They also trust them.
And how many times have I seen that not work out? And maybe they don't even mean to be doing something that's not trustworthy. But they're not an accountant. They're doing the best they can. They're doing that. So really getting that as a company grows, they should start out small, something like a bookkeeper, controller type, but then you're working your way up to CFO, VP finance type people, the bigger you get, and a relationship with the CPA firm and making sure that you're getting what you need. If you're above $1 million in borrowings, you probably need to go up to at least compiled with good CPA firm tax returns. If you're going to be up around the 3 million, you're going to need to be in the reviewed space. And then, 5-10 million, you're going to need to have some audits. And if you don't, then let's just say you're getting a line of credit. The bank's going to want to do field audits. Field audits are expensive. If you had an audit of just your financials, maybe the bank wouldn't need a field audit, or they wouldn't need a field audit every year because they'd be more comfortable with that the numbers you're giving the bank are true and correct. So, yeah.
I love that. And I want to say, and I want to be respectful of your time. So if you need to hop off, absolutely. We'll go ahead and close up.
I can't believe it. Wow. That has flown by, huh?
I know our time is flying by here. I think there's more to unpack. I mean, I think a lot of what you've said today should at least be helping folks realize the importance of great numbers, and really just, get yourself an accountant to look over your books, not just your CPA who's filing your taxes every year, an actual accountant that will go through those books and ask the right questions, because a CPA takes the books from the bookkeeper. That's what they use. Right. And that's it, and a lot of CPAs also, they're compliance professionals, right? So they're looking in the rear view mirror, they're looking backwards and saying what happened, and they're reporting on what happened. But an accountant that is not a CPA and doing tax filings is someone who can be more strategic and help you start making better decisions and projecting. And hopefully for the listeners that we have here, they've gotten at least to that place where they do have some projections and they are working with accountants.
That was my last point on this subject too, is good budgets or projections. And have you ever heard of the SBDC here in Georgia?
Yes.
Right. It's such a great tool for businesses through the University of Georgia system. And every company should go through that process with them, because they're professionals and they can build these projections and analysis for you. And it's free.
It's free. Yeah. And that's the other thing. There's also Scores out there.
Another good one.
ACE, right? Is ACE for women only? I
don't know. I'm less familiar with that.
Okay. I think
I'm going to look into it now.
Yeah, I think they might actually just have like a women's kind of section, But yes, there's so many resources out there. The SBA has a ton of resources itself. And so there's so much more to talk about in this space.
There's so much more.
But this has been amazing. I love talking to you myself, and I'm just so grateful I can now share your amazing knowledge and passion for helping people. Truly. Jill, you are a person who wants to see people thrive, not just survive. And that is when the very first time we met, I feel like that was the thing we knew about each other immediately. And every time I speak with you, I learn more. And I'm just so grateful that you took your time today to speak with us. Is there anything that you'd like to say now, closing us out? If folks want to reach out to you, how they can reach out to you, we'll provide any information, of course, in the show notes. But any final thoughts?
No, but I am happy to have people bounce stuff off of me. And I want to tell you how just incredible it's been I think we were friends within 3 minutes of meeting each other. Like, it's pretty instant.
Yeah.
And we have continued it now over a course of years. And it's just whenever you're on my calendar, I know I'm going to see you. It's a bright spot. And I just look forward to all the great things that we're going to do together in the future.
I agree. Thank you so much, Jill. It's been such a great pleasure. Everyone, please check out Jill. Please be sure to reach out to all the people in your circle, your accountants, your banker, your lawyers, whoever it is that's helping you with these things. Ask them questions. If they're not talking to you about this stuff, it's not because they don't know about it. They may just not realize that you have questions. So never be afraid to reach out and ask questions of those that are there to help you.
Great.
Yes, questions are great. Thank you all. Bye for now.
Thank you.
Thank you for listening to the show. Remember, stay sharp, stay curious, and stay tuned for our next episode. Bye for now.